Hey everyone, welcome to Stock Market Today. It's Ali Corum and Ed Carson here with a look at the action in today's session and how the week played out, which wasn't a very great week, Ed.
No, it was pretty miserable. There was one day where everything looked good, but you can't count on one day. Going to take a look at a few stocks that are holding up reasonably well. Three IBD 50 medical stocks: Regeneron, Harmony Biosciences, and Builder FirstSource.
Okay, let's do that first. Let's analyze the action in today's session with the major indexes. The Nasdaq down 2.2% by the day's close. The S&P 500 down 1.3%. The Dow down 0.7%. The Russell 2000 down about 1.4%. So there was a little bit of a glimmer of hope midweek, but like you said, you can't take just one day out of context. And I think the fact that we didn't follow up on that strong gain says something.
Yeah, that does say something. I mean, the best days in history, market history, come in bear markets or corrections. We're in a bear market right now for the Nasdaq. Yeah, I mean, Thursday, okay, at least we came off lows, but Friday, pretty sharp loss. And looking on a weekly basis, it was a pretty big loss. We're getting near lows again. You can't look at that and say, oh, look, we found support. Well, not really. I mean, so it's just a grim situation, especially for growth stocks. And just investors need to wait to see real strength. I mean, we never even got above the 10-day line on any of the major indexes. And that's just such a weak area. I mean, that should be so easy. If you have any kind of momentum, you should be getting above that, getting above the 21-day line. We're above nothing and still can't hold. So just a really difficult time right now.
It is, but as long as we hold above this late February low, technically the rally attempt is still intact. So what does that mean? We start counting for a follow-through day, and there's been enough trading days for us to have a follow-through day because we're looking for day 4 or later of the rally attempt, which has now been about 2 weeks or so. So we're looking for a strong gain in heavy volume, but let's see, about at the close, and this is a delayed chart, so this doesn't even show how far away we closed from the 21-day line, but more than 4% at this point. So it seems like even if we do get something that can quote unquote confirm this rally, it would come with a lot of caveats.
Yeah, having a follow through day below the 10-day line, below the close of the rally bottom, on February 24th, I mean, there's no momentum there. There just isn't, and it's so weak. Look, I mean, the geopolitics, this coming week, we've got a Fed rate hike. You don't necessarily need to know that. You just look at this chart and know this, but there are obviously a lot of headwinds out there. And, we had all this optimism this morning, quickly faded off of this Putin comment, so you just have to be wary of momentary of pre-market, intraday, even daily moves,
Exactly.
because this trend is weak.
Yes, it is. All right. So stay safe out there. And if you do take on positions, because it is a tale of two markets here, an okay market for stock pickers. If you're picking the right stocks at the right time and exiting them at the right time, there is still merchandise out there, but it seems like an environment where you don't want to be aggressive, even though there are some pockets of strength out there.
Yeah, those pockets they're out there. They're still volatile too. They're still prone to big moves. In a lot of these sectors, and it's hard to get into some of these sectors that are doing well, like energy. A lot of those are well extended, so it's hard to try to enter those areas. It's definitely, if you're going to be in it, to be very gingerly and be as quick to get out as you're getting in.
Yes. And let's take a look at some of the other major indexes as well before we take a closer look at different areas of the market a little closer. So here's a look at the S&P, also below its 10-day line, headed towards the late February lows as well. And look at the Dow. A downside reversal with resistance at the 10-day line, and the Russell 2000 with this IWM ETF also reversing lower today, hitting resistance around its 10 and 21-day lines, which have converged. And let's check in on the speculative growth. So the ARKK ETF, so a proxy for that highly valued growth segment of the market, down 6.6% on Friday and some slightly above average volume. And for the week, down almost 8%, and pretty significant to see where ARKK closed on Friday and for the week.
Yeah, I think we're now at the lowest level since May 2020. So it undercut the lows, I mean, whereas the NASDAQ and the other major indexes haven't undercut the lows, this one decisively broke through there, not even close. The relative strength line, that's the lowest since late 2017. It's a little vague, so it's that kind of, it's not just, it's way back now. So all this kind of area, and it's not just ARK. You can look at a lot of anything with high PE ratios or no PE ratios, and they are just getting crushed. I think we'll look at a little bit, about how the treasury yields were, but the treasury yields, which had come down in the Russia-Ukraine invasion, they decided we're going up. And so it's like, boy, oh boy, that just makes it all the much harder as these stocks that you're discounting future growth, and then those higher yields really put the pressure on growth stocks like this.
Yeah, so you definitely don't want to be married to the leaders of the past. Maybe you did get in the right names in 2020 or 2021, but if you just held on to those and hoped that your solid gains would continue, and now you've seen these big round trips, that's not the position that we want anyone out there to be in. So Dave Chung and I on Barron's Live earlier today, we talked about this and how you can spot that emerging leadership. So if you want more on that topic, go to barrons.com/live to check out the archive. And let's stay on the weekly and take a look at USO, a proxy here, visual representation of the price of oil. So a downside reversal this week, Ed. So losing some steam, but honestly not too surprising after the pace at which it had been running up lately.
Yeah, I mean, this is why we talk about not buying stocks that are, or any kind of thing that's that extended. Yeah, huge run, still the vast majority that's up, but this, had massive gains, and then it sold off midweek as it just sort of, for whatever reason, it just came under pressure because it had run up so much so fast. So oil prices fell this week, still very strong. But this is why, buy extended, and we'll just see where it goes. I mean, there was some big volatility in a lot of commodity plays this week, and we continue to do so.
Mm-hmm. And we know that oil and gas stocks are correlated to this, not a dollar for dollar, percent for percent, but it is definitely worth noting that correlation. And perhaps we are in the middle of a bigger move, but you talked about, not chasing these. So maybe from here, ideally, we see at least some pullbacks or base patterns form for some of these, so we can get another opportunity to get into this group if it potentially does have more room left to run.
Yeah, I mean, we could pull back to the 10-week line. Some of this, not just this, or some of these stocks that have been leading. And, there are some opportunities in that regard. Yeah, there definitely might be. I just think that there's also, just with the headline risk, you literally could have the price of oil drop 20%, and some, like if peace broke out. I don't know when that's going to happen, or, it could be, oil might be at $200 by then, but, that's the kind of thing that could happen.
That's exactly right. Okay, well, let's take a look at the 10-year Treasury yield, 0T index. So a big move this week, right back towards levels that it was at, mid-February kind of levels about a month ago.
Yeah, this was really amazing. I mean, the dollar is really strong. It's not like the Treasury needs to attract. I mean, there's a lot of dollar flows into the U.S. in this environment, and yet still the Treasury yield, for whatever reason, big move heading into the Fed rate hike this coming week. It's really interesting, despite all the concerns about what the Russia war and the sanctions might mean for growth. Bond yields around the world rose really sharply this week. Everything's volatile. You can't. Nothing's really on safe ground right now.
So, is there a general expectation of what's supposed to happen with the rate hikes? Because, like you said, with the geopolitical uncertainty, it was perhaps thought that those hikes are going to be reined in a little bit instead of on an aggressive pace. But what should we be expecting?
I think they probably are going to stay with a bunch of quarter point hikes. I mean, that's just sort of the conventional wisdom, so I'm not really breaking any ground there. But the concern is that on the one hand, yeah, this could slow down growth, and so they might want to back off a little bit. On the other hand, inflation is getting even higher and creating more supply chain issues. And so, like inflation hit 7.9% and probably will go higher, at least in March. So it just makes it a very difficult thing to navigate. I think they're going to try to go slow and steady and try not to go too fast or too slow. But it's going to be a difficult task for the Fed and other central banks to deal with this kind of situation.
It definitely is. Well, we will continue to shape up our watch list. So why don't we go ahead and take a look at a couple of names, which you mentioned, Ed, including Regeneron Pharmaceutical, up some 1.9% today, REGN, the ticker here. So potentially actionable for an early entry. But once again, we have this market backdrop to deal with.
Yeah, I mean, it broke sort of the week high from earlier this week, sort of a trend line that you could draw. And so that offered an early entry right there. And then it also got above 645 intraday. It just came down the last few minutes as the market came under such pressure. Volume ended up turning higher. I mean, that was a good thing and bad thing. It was really weak early on. Then it started picking up steam and it really gained ground at the very end of the day. Some of that was probably selling pressure. So that's not the best thing to see, but still, a solid day. I think in general, though, okay, this was nice. The RS line is nice. If you go on a weekly chart, you can see how it really, how tight the closes were up until this week. Really tight closes. There, the RS line hitting new highs for a 52-week high, certainly on a weekly. So there's a lot of positives there, but it is going to be hard for any stock outside of those special commodity areas to make any kind of meaningful advance if the market is selling off like it has been.
Yes, that's a good point. Let's also take a look at Harmony Biosciences, HRMY. HRMY. If I could type here, another RS line blue dot stock on the weekly, but with a gain of 9% this week and 6% last week, it seems like the best thing that could happen here is for a handle to form. Let's see what it's looking like on the weekly, perhaps the beginning of that.
Yeah, so maybe you get sort of a highish handle there. So if the market went sideways or down a little bit, it wouldn't be the worst thing for Harmony because it did rise quite a bit in the last few weeks. There was probably an early entry a couple of weeks ago, but that would have been hard to hold because there was a big shakeout day in there. So somewhere in there. So by the time, it came out of that, it's getting a little bit extended. So yeah, pretty good growth here. It's supposed to fall in 2022. So it is for Regeneron a lot, but it's going to bounce back for Harmony in 2023. Both Regeneron and Harmony have relatively low PE ratios. So that's a positive in this market environment. There's a lot to like about this when this was a New America a few weeks ago. So definitely worth watching, reading about what the heck they do and why it's had a pretty good growth track record.
All right. Well, we'll keep it on our watch list. Let's also look at BLDR. This was our stock of the day on Friday as it works on a base. I think if we go to the weekly, we might just see close to a blue dot. I think if it maybe climbs a little bit more, we might get the blue dot on Builders FirstSource as well.
Yeah, and so 6 straight weekly gains, a lot of them pretty small, but fairly tight action. And on the upside, which is nice given how the market is. I mean, the market hasn't been doing that. I think we'd all be pretty happy if the market could pull off 6 weeks like that. It found support above the 50-day line. There was probably an early entry if it can get above last week's high or maybe even some trend line. But, really something like that seems fine. It's a little too deep to be a handle, but that sort of works in that regard. Yeah, you could sort of see it hit resistance there. like the other ones, it's supposed to have lower earnings in 2022, though it's after a booming 2021. All of these had huge 2021s. Their earnings are going to drop a little bit in 2022, but still be above pre-2021 levels. This is they do some lumber products, doors, windows, so that's still a pretty strong area. This is one that it's, again, like the rest of these other ones, you need the market to do something to not tank 2% a day. You really need that. You just can't buck that tide. But it's one that if the tide does turn, this is one that definitely investors should be looking at.
That's exactly right. Okay, Ed. Well, it seems like investors should shape up their watch list this weekend because you never know what a new week could bring. But I think even if the market does get worse from here, that's not the time to check out and just stop paying attention to what's happening.
Yeah, I mean, we could undercut lows, which wouldn't be the worst thing because then we could start off a new, rally. It just sort of feels this one's pretty sickly. And you just don't know when it's going to turn, and it could turn very quickly. It looked so bad in late 2018 when we had that third leg down, and it just went pummel, 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 and then it turned, and very quickly there were a lot of opportunities. If you did get into things this last week, got excited, bought on Wednesday, say, probably want to be scaling out. But yeah, otherwise, I think it's like stay engaged, build up those watch lists, be ready. But that's what people should be doing, getting ready, but don't cheat. Don't try to get in early.
Exactly. Yeah, we always talk about how we want to be flexible and keep an open mind to any scenario. So whether that's on the downside or the upside, so that way you're not left behind if we do start seeing a big move higher, but also so your portfolio doesn't get caught in a trap door if we do see another leg lower. So we just gotta stay limber, stay flexible out there. Mentally.
That's right. It's going to be where it's going to be a wild weekend, perhaps of headlines. Who knows how things will open up? Just the more you're on the sidelines, it's easier just to keep mentally fresh and be ready for when we turn, and that could happen anytime.
Mm-hmm. All right. Thank you, Ed, and thanks everyone for watching. We hope you have a great weekend, and we'll see you right back here next week.